Hello everyone, a lot of talk lately about gold getting absolutely smoked, about whether the move is telling us the bull market is over, and about whether anybody buying this weakness is just catching a falling knife. So in this video, we're going to separate panic from process, and you're going to walk away a whole lot clearer on what likely happened, what probably didn't happen, and why this drop may matter a lot more for opportunity than for fear. And here in New York, it's Friday, April 17th. Let me know in the comments what day and date you're watching from. And if you value the work here, support the channel by subscribing and commenting John AG Best so I know you're part of the real crew. Now the first thing we've got to do is slow this thing down, because when gold falls hard after making headlines, people instantly reach for the most dramatic explanation available. They want one villain, one smoking gun, one clean answer, but markets almost never move that way. They move like traffic in a storm. One lane closes, then another, then suddenly everybody's honking and nobody remembers what started the jam in the first place. So what actually changed? In my view, the simplest explanation is this. A very strong move got crowded. A risk event scrambled global funding needs, the dollar caught a bid for a stretch, futures traders got squeezed, and gold got sold for reasons that were more mechanical than philosophical. That's the key distinction. A price drop does not automatically mean the long-term thesis broke. Sometimes it just means the market had to raise cash right now. And that matters because there's a huge difference between selling something because you hate it and selling something because it's the one thing in the drawer that's liquid enough to meet the moment. That's especially true in metals. Based on recently published numbers, official sector buying stayed historically elevated last year, and central banks still kept adding at a pace that would have looked extraordinary in most earlier cycles. That does not look like broad institutional abandonment to me. Now, could some official holders have sold into stress? Of course, that's what reserves are for. If energy costs jump, if currencies wobble, if funding markets tighten, gold can become the asset you monetize because it's liquid and globally recognized. That doesn't make it bearish by definition. It can actually prove the opposite. It can prove the asset still matters when things get uncomfortable. But I also want to challenge one popular idea here. Not every sharp drop has to be explained by some giant hidden plot. Sometimes the answer is less cinematic and more brutal. Leverage gets too big, traders get too comfortable, margin math changes, the fastest money gets thrown overboard. And because futures markets set the headline price, that paper selling can make the whole move look deeper and uglier than the physical market feels on the ground. That paper versus physical split is where a lot of people get lost. They hear the price fell and assume demand vanished. Those are not the same thing. From recent market updates, gold has been hovering just under the recent highs again this week, while silver has also been firming, even after both metals took a beating during the worst of the liquidation. In other words, the market didn't disappear. It bent, then started trying to stand back up. And pay attention to how quickly sentiment flipped. A few sessions ago, the conversation was all about whether peace headlines would cool the whole trade. Then the very same market turned around and started treating a softer dollar and still fragile geopolitics as support again. That kind of whip is exactly what you see when a market is trying to transfer ownership from hot money to steadier hands. It's noisy, it's uncomfortable, and it's why so many people buy tops emotionally and sell dips emotionally. Are you looking at this move like a threat or like a reset that's forcing you to define your thesis properly? And if you think this volatility means the thesis is dead, you're probably trading emotion, not structure today. And when you zoom out, the macro backdrop hasn't exactly turned friendly for complacency. The Fed held rates steady in March, inflation re-accelerated in the latest consumer price report, and energy was a huge part of that story. The government's own debt tally is now sitting just shy of $40 trillion. So if someone tells you the environment suddenly became simple and stable, I'd love to know what planet they're trading from. That's why I think the better framework is not gold crashed, therefore gold failed. It's gold corrected in a world where the reasons people own gold are still very much alive. Big difference. Because the long game for gold has never depended on a straight line. It depends on confidence, purchasing power, policy credibility, and the willingness of investors and institutions to look for something outside the promises of governments and balance sheets. And remember, this market did not come into the year weak. Gold had already logged a remarkable run through last year with dozens of record highs, while official sector demand and investment interest stayed strong enough that major industry research entered this year still expecting geopolitics, central bank diversification, and ETF flows to remain meaningful support. So when a market with that kind of underlying momentum gets hit by a hard liquidation, the smarter question is not just why is it down? The smarter question is who had to sell, who chose to sell, and who is now stepping in on the other side. Now let's talk about the dollar piece, because this is where a lot of people get tripped up. They hear geopolitical tension and think gold must go straight up. Usually, maybe, always, no. If an energy shock pushes inflation higher, then rate cut expectations can get pushed back, and the dollar can strengthen for a period, even while fear rises. That creates a weird window, where the safe haven everyone expects to soar gets weighed down by the currency everyone still needs for immediate settlement. And we've seen that tension already. More than once over the last couple of weeks, gold softened when the dollar firmed, and traders started pricing a tougher path for easier policy. Then, when the dollar backed off and peace headlines reduced some of the inflation panic, gold stabilized again. That back and forth doesn't prove the bull case is broken. It proves gold is trading inside a messy macro tug of war, not a fairy tale. Now, another reason I don't think this is some neat little game over moment is because the structural buyers never really left the room. China's central bank has kept adding gold month after month, and recent gold market updates also pointed to firmer imports and steady buying on dips there. That matters, because when Western speculators puke positions but long-duration buyers keep showing up, the character of the decline is very different. And then there's the insurance angle in China, which a lot of people still underrate. Regulatory changes there open the door for insurance money to move into gold, and industry analysis has described that as long-term structural support, not a cute headline that fades in a weekend. When a market adds patient pools of capital, that changes the floor over time, even if it doesn't stop every correction in the moment. And there's another physical market wrinkle that people aren't talking about enough. In India, banks have temporarily halted fresh bullion import orders because of a government clearance delay, leaving metal stuck and creating a weird little bottleneck, right as seasonal buying interest would normally matter. That doesn't mean demand is exploding there right this second. In fact, high prices have made some buyers cautious. But it does mean the physical market is dealing with real frictions that don't show up cleanly if all you do is stare at a futures chart for 10 seconds and declare the whole story over. If you're successful, share your success story in the comments so others can stay motivated. Now silver. Because whenever gold gets hit, silver usually acts like gold's caffeinated cousin and takes the stairs on the way down. But the longer-term silver story is still complicated in a bullish way. Recent silver research says the market is heading for yet another deficit year. Inventories have been drawn down heavily over the last several years, and physical investment demand is still expected to stay strong even with industrial demand cooling a bit. That is not the profile of a dead market. And here's the nuance people miss with silver. Yes, some industrial demand is easing because manufacturers are thriftier and substitution is happening in places like solar. But even after that, demand is still historically large. So the story isn't industrial demand vanished. The story is an already tight market is trying to rebalance while investors keep treating every drop like either the end of the world or the start of a moonshot. Reality usually lives in between those two emotional extremes. That's also why I'm careful with all the exchange breakdown talk. Could stress build? Sure. Could rules change if things get disorderly? Also sure, we've seen markets do that before. But rooting for a full-blown failure is usually fantasy masquerading as bullishness. If a major pricing venue truly breaks, that doesn't create a clean, beautiful payday. It creates confusion, liquidity problems, legal uncertainty, and all kinds of be careful what you wished for consequences. What you actually want, if you're constructive on metals, is a repricing process that remains messy but functional. You want more people to realize paper promises are not the same thing as scarce assets. You want institutions to keep diversifying. You want retail investors to stop panicking every time a correction shows up wearing work boots. And you want the reasons for owning precious metals to become more obvious without the plumbing of the market catching fire. Now let's add one more layer that was not getting enough attention before this drop. Logistics. When energy routes get strained and insurance costs rise, that doesn't just hit gasoline. It hits shipping. It hits freight. It hits metals movement, refining timelines, and regional premiums. The head of the IEA warned this week that the fallout from the Middle East disruption could last a lot longer than traders may be assuming. That matters for inflation, and it matters for real-world bullion flow, not just screen prices. And if inflation pressure hangs around while growth confidence cools, then policymakers stay stuck. That's where gold starts to look interesting again, not as a magic asset, but as a rational response to policy discomfort. The Fed can hold steady. It can talk tough. It can wait. But it can't instantly erase the tension between sticky prices, heavy debt loads, and a world that keeps throwing supply shocks into the machine. That tension is exactly the kind of background noise gold tends to feed on over time. And speaking of debt, this is where the bigger picture keeps leaning back in favor of hard assets. When federal debt is already close to 40 trillion, when long bonds are sensitive, and when even seasoned policymakers are warning that treasury market stress would be vicious if it ever arrived, you don't need to be a doomsday guy to understand why people want something outside the credit system. You just need to be awake. So should you buy the dip? That depends on what you thought you were buying in the first place. If you bought gold because you thought it only goes up during scary headlines, then this correction probably feels like betrayal. But if you bought it as insurance against monetary slippage, debt saturation, policy paralysis, and the slow erosion of trust, then a sharp sell-off caused by liquidity stress doesn't kill the argument. It might actually refresh it. Same with silver, maybe even more so, because silver has a habit of offending both bulls and bears before it picks a direction. It can stay volatile longer than people expect. It can look expensive to the crowd and cheap to history at the same time. And it can absolutely make you question your sanity in the middle of the move. That's normal. Silver does not hand out conviction cheaply. My own take is pretty simple. The drop looked more like a funding event than a philosophical rejection. The rebound attempt tells you buyers did not vanish. The macro backdrop still has too many pressure points to dismiss. Central banks are still behaving like gold matters. China still looks engaged. Silver still has a real supply story. And the inflation debt rate triangle still looks uncomfortable enough to keep the long-term case breathing. Now, does that mean you back up the truck blindly? No. That's not how adults do this. You size properly. You think in tranches. You decide whether you want paper exposure, miners, or actual metal. You think about storage, jurisdiction, premiums, liquidity, and why you own the thing before you own it. Because conviction without process is just emotion wearing a tie. But if your question is whether this move automatically destroyed the bull case, my answer is no. I don't see a broken thesis. I see a violent reminder that bull markets are not elevators. I see a market that got stretched, got hit with a liquidity wave, and then started rebuilding itself in the same ugly macro environment that made the metals story attractive in the first place. And maybe that's the real lesson here. A lot of investors say they want protection, but what they actually want is protection that never goes down. That product does not exist. Real hedges can be volatile. Real safe havens can correct. Real opportunities can feel terrible right before they make sense again. That's why most people don't hold them correctly. They want certainty when the whole point was preparation. So no, I'm not celebrating the crash. I'm not pretending pain is fun. And I'm not telling you every wild claim floating around the internet is true. I'm saying the move makes more sense when you look at liquidity, dollar pressure, futures mechanics, and ongoing structural demand all at once instead of grabbing the loudest headline and building a religion around it. If this is the phase where weak hands get shaken and patient capital starts picking through the rubble, that would not surprise me one bit. We've seen that movie before. The names change, the catalyst changes. The emotional script stays weirdly similar. Panic first, explanation second, opportunity much later when nobody wants to hear the word patience anymore. That's the setup I'm watching now. And as always, this is for education and market perspective only. It's not a buy or sell order, not personal financial advice, and definitely not a substitute for doing your own homework before you put real money into anything.